I just want to go ahead and welcome everybody to today's call. My name is Joshua Wenner, and I'm the president of Co-Founders Lab. I want to welcome you to a Startup Accelerator mentoring session, group coaching mentoring session. We have 3 advisors on today's call. One, we have Steve Lehman. Steve is the chairman of Business Rockstars. For those of you that haven't met Steve before, he's had 2 9-figure exits, and he's been CEO of both New York Stock Exchange and NASDAQ companies. Little haywire today, and he's been an investor in over 50 companies, so he can give you a wide perspective on what an investor looks for. Also, if you're growing and scaling a company, he knows those markets very well. We're also joined by Erik Bullen. Erik's been on a number of times, entrepreneur, startup advisor, investor. He's also sat in a number of helping startups get up and running, both from a founder role, an executive role, and an investor role. So he's helped hundreds of founders help get their business started, up and running, scaling, and he's really about actionable and fundable strategies to become better leaders. Thanks for joining us today, Erik. If you just give a little shout out so everybody sees who you are. And then we're joined by Pedro. Pedro is CEO of InEvent, and Pedro's joined us before as well. And he is a Y Combinator venture-backed company, his current company, and they do event marketing. And he's been a sales platform for Forbes 2000 global companies, including all the big companies like Amazon, Coca-Cola, and Unilever, Citibank, a number of other ones. And he previously started a company in college where he got 10,000 members, paying members up and running, monthly members. So has a lot of experience in bootstrapping, getting things up and running, and also hustling with this current startup, and can provide a lot of perspective. And I wanted to kick off the call first with, you know, we're in an interesting landscape with both what happened with COVID and how COVID's adapting, and just a number of different things that have happened from a marketing perspective, a global perspective. So I'd love to start off with either Erik or Pedro, just giving an example of what you're seeing currently in the startup landscape, the business landscape, with how COVID's advanced, what's happening, where you see either opportunities or challenges in the marketplace, and just to give the lens from what you've been doing and the companies you've been working with, and any insights or distinctions that you've been noticing. And either Erik or Pedro could go first.
Yeah, do you want me to go first, Joshua?
Yeah. You can go ahead, yeah.
Okay, all right. Yeah, so you see a few things. I would say we're probably in week, 14 of this right now, right? Mm-hmm. The first few weeks, no one knew what was going on. It was full stop for everything. I think we're at a point right now where we're starting to see the light of how we're coming out of this. You know, let's take a look at it from a few different perspectives, right? From the investment perspective, and then on the flip side, from the funding perspective. There's definitely more money on the sidelines right now, right? The money and the capital that's been deployed is probably down by about 20 to 30%, depending on what stage you're looking at, and whether you're looking at the pre-seed, seed stage, where a lot of angels play, versus the A+ series stage, where a lot of the VCs play. So I think there's still money on the sidelines. That doesn't mean funding isn't being done. You're still seeing deals being done, either those deals that have been in progress, or those deals where money is being invested in those companies that are actually being able to take advantage of this, right? Of this new COVID-19 world, either the current world or the future world. If you look at, let's say, from the industry segment perspective, healthcare, wellness, fitness, in some ways remote, right? Those are companies that are being invested in. Companies that are providing the future of work, let's say remote work and collaboration, those companies are still getting money today. Just today or yesterday, it was announced that Hydro, they're competing directly with Peloton. They're up here I'm based in Boston. They're based in Cambridge. They just received a $25 million investment, Series A round. So money's still out there, but I think more judiciously so. And there's more money downstream than upstream right now. But I think the money will start to loosen up over the next few weeks, if not months, as long as we don't have a regression on things. In terms of let's see, from a startup revenue perspective, NFX recently did a survey. They did a couple of surveys of the past few months. The response from the startups was that about 40% of the startups saw a decrease in revenue, 40% saw an increase in revenue, and then the remaining 20% were about even. So if you think about 60% of startups either had an increase of revenue or are even right now or flat. That's probably not as bad as everybody expected it to be. And I do see some examples of companies that are really taking advantage of the situation right now and really pivoting in many ways to look at how do we need to act and behave and what kinds of services can we offer in this world and in the future world as well once we get out of this. There are a couple companies up here in Boston that I'm working with. One is a marketplace in the medical device space. And they originally focused on large, call it genome sequencing machines. They're now pivoting and adding a layer on top where they're now adding test kits as well for COVID-19. So they're doing really well, and they're really preparing themselves to work with enterprises that are going back to work now. And I mentioned Hydro, for instance, from the remote fitness kind of trend that's happening right now as well. So money's out there. I don't think it's as bad as people expect it to be. That doesn't mean that there's certain industries that aren't impacted. So for instance, if you're looking at ad tech, if you're looking at leisure and travel, sports, and a few other, the restaurant industry, we have Toast up here in Boston, a huge impact on those organizations, right? But I think those will start coming back as well.
Thanks so much. Really, really broad perspective and helpful perspective for those that are thinking about money or just understanding what's going on. Pedro, did you have other thoughts and reflections just from what you're doing and building and the lens you're looking through?
Yeah. I think like I won't be as complete as Erik was. I'm just going to provide some key insights that we had from our business perspective. We saw that in February we had a really decrease in the amount of revenue coming from companies and events, especially on the marketing side, especially promotion. There was a decrease between March and April and also May. But then in the last few months, in the last actually 2 months, we actually had an increase about 250% back on business. So actually it's better. June is actually better than what we were at in January because companies are actually moving all their assets to go online. So they actually may not be spending on ads, but they're actually spending on video conferencing tools. So that can be either like Zoom, something like Zoom, or other tools like the in-event virtual lobby, what we have promoted, our company actually promotes, which is going to be a way for them to connect and go on a different experience. So what we have seen is that all these companies are increasing the way they're going to actually spend online because they have been adapted now to the remote model. And they're seeing this, so they're actually adapting to this new perspective. And they're actually saying like, this is the thing now that we are going to see in the future. So what's the best way to deal with this? So let's move everything to be online and let's create this new company culture. Let's create this new way of understanding our vendors. Let's create this new way of understanding our customers. And I don't see that they're just doing that for like until COVID ends. Actually, they're believing that this is going to be something that's going to be for the foreseeing future. Like they're thinking that this is going to be for 2021, 2022, 2023, and that's going to be the way that customers are going to interact with the brands. So I think like June, like it's much better than what we was in January, and we're growing a little bit actually in the last few weeks. So I think it can be a positive thing. Like if we're going online, if you have an online business and serving this, I think that can be great. And also just complementing on the other side of the amount of investing and how much revenue is also coming from new platforms. We had rounds of about 15 to 20 million being closed recently in the video conferencing space. So I think that the space is also really hot for new investments. Yeah.
Great. Thanks so much, Pedro. Really appreciate your insights. And both Erik and Pedro are on our Co-Founders Lab Advisor Network. Kasha posted the link. We've vetted 50 advisors. So if you're looking for an advisor, either for your advisory board to balance out your team or wanting to personally do a session with Erik or Pedro, the link is on there. There's also the link for the accelerator if you want to get in line for questions. We always start off first with our accelerator members, and then we open it up if our accelerator members to additional members that are on the call. I wanted to start off first. If you got questions, go ahead and post them in there, and we'll just start to go through the questions and answer them. Rich, I know you said you had a question, but I think it was helpful. You're basically talking about you're getting questions from different investment banking firms. Did you want to go a little bit deeper there, or did you feel like you had your question answered? Let me just see where you're at. There you are. I think you have to unmute on your end.
Can you hear me?
Yeah, we got you now.
Okay. So so they identified 1,000 merger and acquisition targets from big to small, but they said come back with somebody bigger than you. So I know the industries whose door I have to knock on. There's actually 3 separate industries because my algorithms apply to 3 separate industries. There were a couple pivots, but they're all good. So is there a type of company that shops these for you? But I also, later on, I said, gee, I think I answered my own question. You're going to say get an advisor.
Yeah, but and just so you have some context, just give an elevator pitch, 30-second, on who you are and your business and where you're based out of.
Did You Weekend answers the question, what do you want to do this weekend? I'm based in Albany. I won first place at the RPI Incubator. We've had several pivots since then, but basically it is an upsell for media that addresses both media, healthcare issues, and also not-for-profit issues.
Great. And I wanted to take that to Erik first. Erik, did you have any thoughts on that from the investment space and what he was hearing? Because it may apply to other entrepreneurs on the call that are hearing similar feedback.
Yeah, I mean, say, hey, Rich, can you just restate your question just in specifically what the ask is in this case?
So one of the investment banking firms said, you have 2 ways to go. You can either go out and get seed money, which is very often very difficult, but any door you knock on, when you pitch it to them, they're going to want it coded their way. So find the right partner, for example, a media company or a healthcare company that can code this for you and roll it out. So a strategic partner.
So it sounds like you have your product or business is tied very specific or customized for a particular industry, in this case, healthcare potentially?
I'm sorry, you broke up a little bit.
It sounds like your product needs to be customized for a particular segment or industry such as healthcare?
Well, yes, because it started out as pure travel and tourism. And then I was sitting down with somebody, a board of directors for healthcare. And he said, Richard, you know what? This is brilliant. You're right. This is travel and tourism, but it's healthcare also. So once I started to explore that, then it pivoted also to a third entity of not-for-profit. So it can literally change the way not-for-profits raise money. But I'm solo. I don't have a team. I'm older. I didn't pick a team because I'm sorry, young guys, a lot of you give up really, really fast. And I've bootstrapped the whole way. So I'm ready to pull the trigger, but I need that larger partner or something to help me find it.
And I'm sorry, when you say partner, is that you're looking for customers at this point or potential investors?
The company that either or, I mean, whichever way is the shortest point between, shortest line between 2 points. But if I knock on, for example, a healthcare door, they can roll this out. It's literally scalable worldwide. If I knock on a media door, and it can be a newspaper or any type of media, they know how to leverage the infrastructure to roll this out worldwide. So and the same to not-for-profits. So the one company that partners with me can roll this out to media, healthcare, and not-for-profits. So they always say, if there's a pivot, go with the first business first, which is travel and tourism, and then it can meld into the healthcare, and then it can meld into the not-for-profit. So I have 3 fantastic different avenues I can take, but I'm kind of grinding, I'm at a standstill because there's 3 of us, me, myself, and I.
Yeah. So I'll kind of view it from an investor perspective. If you're looking for investment, right, and the way I would look at your business. So you've got 3 lanes to pick from at this point, and you've got limited resources. So one of my questions would be, of the ones that you choose, right, where can you get the best traction and the most return? And then the best longevity, where can you scale, right, of those 3 businesses? And then All three, but is there any difference among those three, right? If you had to choose one, right, which one would be the best return at this point where you can gain a beachhead and continue growing your business? And then of those three, potentially, do you have any one of those three where you could actually get a paying customer, right, as opposed to, let's say, a pilot or an unpaid engagement for the time being?
So let's say let's say I go with media, just as an example. So I could knock on the door of a newspaper software company and say, here is a project you can offer to your 5,000 newspapers. And there's not one, I got a national on this, not one newspaper that would say no to it. It's a natural sell. For every $100, it's a $150 upsell. And that's from a national endorsement. But you can say the same thing for the not-for-profit sector and for the healthcare sector. So it's self-perpetuating. There's no real, I'm not going to say there's no marketing because everybody needs some marketing, but one of the three industries that I hook up with is going to it's in all three of their best interests to cross-promote this. If you're an advisor, I'll sign up for you.
Rich,
if you can.
Rich, let me jump in here for a minute. If you've got three lanes that you're going down, to Erik's point, you should probably try and look at the lane where you can get some quick traction. Now, I'll tell you, in fundraising, the difference between showing traction and not showing traction is the difference between a valuation that is much higher and you getting highly diluted along the way. So, what I would focus on, you've mentioned a lot of things, strategic partners, three different tracks. Try to get traction with whatever lane you think is the easiest to get. And by the way, it's okay, to try all three lanes, but because you're me, myself, and I, the most important thing you can do is to show traction. You show traction, then number one, it's easy for strategic partners to come in. Number two, it's easier for investors to take a look. And it's going to be so much easier to get funding. And by the way, a strategic partner and an investing partner, oftentimes is one and the same.
Can I address that?
Sorry?
So if I may address that. So I built across the years, this was always fun. It was a hobby. It was never a business idea until 2 years ago. So it gained traction, and it went from this area into Massachusetts, and then Quebec said, oh, can we sign on? And then Barbados was asking.
So do you have paying customers?
I never had the technology that could accomplish it. I went from Drupal.
All right, so look, I will tell you, wearing my investor hat, and look, we've got a lot of questions, so we got to move on, but wearing my investor hat, it doesn't matter to me as an investor, whether you have Barbados and this and this. What matters to me is that you have customers, even if they're free to begin with, that you will ultimately find a path to monetization with this thing. If this is a no-brainer, listen, if this is a no-brainer for newspapers and it's immediate traction, go in and close 5 of them. All right? You need to create your own path. All right? It's, you've gotten accolades. Now you need to go out and actually get some customers to this thing. But
do I need proprietary software, or can I save that down the road when I get investors?
Well, if you have proprietary software, that's great. Again, I go back, you need to get traction. You've got great ideas. You've got people who are embracing, what you're doing. Go out and close some deals, man. All right.
Got it. Excellent. Thank you so much.
Sure.
Thank you.
Thanks, Rich. Okay, great. I'm going to move on to Jesse Taylor. Jesse says, when should a pre-revenue startup start looking for angel investors? Are you on, Jesse?
Yeah, I'm on.
Okay, great. I'm going to start off with Pedro. Pedro, you want to answer that question? And again, before we go a little further, Jesse, would you just give your your name and your 30-second elevator pitch on your startup.
Yeah,
So just
that'd be great,
so Pedro has some context.
Okay, I'm Jesse Taylor, founder and CEO of KidLink. KidLink is a virtual learning table for parents that does not stay in the same household as their child, but to incorporate a video call where a child and parent can read and learn together. We will offer a library of ebooks and have an option to upload homework where parents and their kid can collaborate and work on it together.
Great. And your question was, when should a pre-revenue startup start looking for angel investors, correct?
Yes, because we are launching the beta app and giving it away for free. I want to know, once that has established and we getting testimonies, when should we start looking for angel investors?
Great. Pedro, you want to address that?
Yeah, I think it's the same question that we were talking about before. Like if you can get, revenue before you're able to raise, your valuation is going to be much better and you're able to dilute much less. So when we raised, for example, we were able to get a higher valuation because we had all these customers already using the platform. And you can do all of this even if you don't have like the product. Like you can start with something that's going to be even like with products already there, and then you can offer this using even like integrations with Zoom or something else. The best way usually to get investor interest and get them to close deals is usually if you have traction. It can be not only revenue. It doesn't need to be US dollars. It can be anything. It can be users. It can be daily users. It can be people that are going to somewhere, people that are accessing your website. If you show them that you have this option to transform dollars into attention of people and how they're going to interact with your platform, that's the best way to prove this. And there are a lot of benefits regarding all the server costs and everything. You can offset most of them because all these companies are offering their products for free. So Amazon or even like all these server companies like Microsoft and others, they're offering all these credits that you can use to host them, and you can use their products without any cost in the first moments. So my recommendation is usually if you can close some deals, or if you can bring some new users and show traction, it can be like, hey, I had 10 users this week, then I onboarded 100 new families, then I had 1,000 new families, and they're just accessing my product. That's the best way for you to get an investor to reach out to you and maybe join an accelerator. Like when we joined Y Combinator, they actually selected us because we had a clear increase over the years, and that's what they were looking for.
Thank you.
Yeah.
Yeah, Josh, you just say comment. So Jesse, just by you asking when you should raise, my first question to any founder will be, do you have to raise money, right? Because I think there's some businesses that can bootstrap and that can actually turn into healthy businesses by just continuing to bootstrap or getting small investments up front, right? But let's argue that you do need to fundraise in order to continue to grow. As Pedro said, the more traction you have, the odds of you getting investors lined up and investing in business just increases the odds, right? There are very few on the angel side. There are some angels that will invest in companies pre-revenue, right, and even pre-product. But what they'll take a look at is the team, right? And it's going to be harder for you to raise money at that point if you haven't had a successful business or successful exit, right? If you're a first-time founder. So the odds of success just decrease in the investor's mind. So again, kind of going back to getting traction, there are angels out there. They're just harder to find, right? And money will be scarcer than if you did get traction, if you did get revenue, if you did get some kind of metrics that can show that you can actually a growing business and that you can scale. And then eventually you get, the funnel of those angel groups just invest at, or individual angels as well will get wider for you.
Great.
Just wanted to comment on the thing. So, and also if you have a clear target of how much you want to raise, I think that's the best thing. Like we wanted to raise like, hey, I need $2 million. Do you really need $2 million? Can you do it with, 100K? What's actually the minimum amount that you can raise to build the first interaction of your product to go to the next step, and then raise more. So I think that's also there's something that we went through our process. Like we actually needed 5x less than we expected. So that can be a great exercise also for you to get to the first step, get to the door and then advance and create the business and everything. Yeah.
On that comment, Pedro, curious and real quick, and I'd love Steve, your feedback too in a sec, but the difference between valuation of what you thought you needed to raise and what it would have cut you down to versus what you actually needed and what you kept in value. Just as did you have a pre-valuation or evaluation when you were looking to raise 2 million versus 100 or 200 grand?
So I think the valuation was the same, but it's easier for you to get a check, for 25K than it is to get for 500K. 25K, I got checks when I was fundraising, actually in a few hours. I was just talking to the investors and I said, like, this is the idea. He said, like, let's move forward. And the 500K check, it took like 3 months to get that. So if you're able to get, checks of 25K from people that or even investors that are willing to invest in the idea because it's too early stage and they can do this, it's also going to be easier for you to get, maybe you can get like 4 checks of 25K. That's it for 1 year. You're ready to go for a full year, build the first interaction of the product, bring, 10,000 users, and then you go to the next step. That can be the greatest market fit that you can ever find. Yeah.
Steve, did you have additional comments on that as well?
The only thing I'll add is, look, the first money is your most expensive money. And you need to weigh, as Pedro and Erik alluded to, how much you really need to get it done and to show traction. There's a company that I'm an investor in, and when I joined the company on a board level, they were in the process of doing a $10 million raise. And the fact of the matter is they really needed $2.5 million. And so they had struggled for a long time to try to bring 10 million in. They were pre-revs. They were in a $1 billion marketplace. They had proprietary technology, but the difference between finding 2.5 million and 10 million was exponentially easier. So figure out really what you need to prove your case so that, you can show for the next round of investors what you were able to do. Then your next raise is going to be, now we need money to scale. And by the way, that's a much different story to an investor than we need money to launch and I got to hire a CFO and I got to hire a CTO. And, nobody wants to hear that from a startup. So take what you can get to prove your point. And by the way, the point can be monetary. The point can be traction with customers, clicks, whatever the matrix is with your company. Investors will look at all of those. So if you're scaling with users, downloads, that's just as important as revenues to at least to me and to a lot of the investors that I know. So raise the money to get traction so that the next round will be, we need money to grow this instead of we need money to launch it.
Okay.
Thanks, Jesse. Okay, moving on to Zakir. Did I pronounce that correctly? Go ahead and unmute yourself as well. Great. And if you just announce your company, 30-second elevator pitch.
Yeah, my startup is a Flex Job Inc. Basically, we match between the job seekers and employers together. But the difference is that our target market is the blue collar, the mom and pop small businesses, where the staff turnover rate of staff is very high. You get staff coming in last 3 months and he will go missing in action and without notice. So with the one press of a button, the employers, we get a backup staff. So that's what we do. So for now, Mike, shall I ask the question now, Joshua?
Yeah, is it just this one here where you found a co-founder and now you're talking about equity, and how do you decide on the percentage of equity investing for your co-founder?
Yep, that's the one.
Great. Erik, would you be open to speaking on that one?
Yeah, sure. I think that there are a number of different, I guess one question is, how long have you been at this point? You're the only person, you're the founder, and how many years have you worked at this?
So far, I've found one co-founder, the tech co-founder. So yeah, and he's building the app, but I've been trying to get this up and running for the past a year or so.
Right. Okay. So you have the co-founder right now, and you're trying to figure out how much to give that person. Okay.
Yeah.
So everything's negotiable, right? But you've got to think through what's fair and equitable for your co-founder in this case, right? And you can certainly go 50-50, right? If you think that's fair. And if that person brings exactly the same thing to the table as you do, has the same investment, time and money and everything else, right? What they put in. If let's say you get a co-founder board, let's say after a year of you being at this, right? and they might not be as invested, right? They might have certain networks that they bring to the table if they're more on the business side, right? They may be good at sales, but they're not core to your product. Maybe you argue that, hey, it's fair to do 30 or 40%, right? So there are a number of different frameworks out there, and there's some which are kind of very mathematical, right? Where you can go through spreadsheets and assign points essentially. Others are more, right, depending on gut and feel, right, what you negotiate. I would say you were asking about a cliff, right? Always have a cliff, right? And that goes for yourself, right? If I'm looking at you as an investor, right, I want you to have a cliff for your equity. And then you need to have a cliff for your co-founder as well. You don't want to have somebody come on board as a co-founder and get equity, and 3 months later they're gone, right? You want to make sure that you do have chemistry, that you can work together really seriously for the long term, right? So make sure you've got the right agreement there in place.
Right, in terms of the initial equity, or do I get it zero first and then do it vested in a couple of months or years? Yeah.
Traditional cliff is 4 years, right? 1 year cliff and then 4 year vesting overall. And first year 25%, and the remainder vested with those next 3 years.
Right. Okay. Thanks. Appreciate that.
Great. Moving on to, this is just a question towards investors. Whether Erik, Steve, or Pedro on the investment side. Just curious, sounds like how many investments do you make a year, and what's a typical investment size? I know there's different strategies, different size. Your guys' perspective on that, on average. Steve?
My personal investment can range anywhere from 100,000 up to 3 million. And 3 is kind of the highest that I make. I typically invest with other people. So if there are other investors that are coming in, I'm more favorably inclined to come in with another group. I also, investors change their strategies as the years go by. I am investing a lot less in startup and seed and pre-revenue, and more in early stage revenue or traction into Series A. And one of Zakir's points, it's hard when you are a solopreneur and you're trying to grow your business. And that's Co-Founders Lab is a great place. We're glad you're all here because it's the largest place on the internet to find a co-founder. But you also need to be aware of what investors look for. And investors do not like to see solopreneurs. All right. It makes me uncomfortable. When I was doing a lot of seed investing, 10, 12 years ago, I was making probably, 25 to 30 investments a year, primarily in seed and startup investments. And, most of those don't work out, and a few of them work out really, really well. And those of you that have been on this platform know that best investment I ever made was in a young entrepreneur I met named Mark Cuban. And I was a first round investor in broadcast.com. We put up $2 million in that deal and exited for close to 300 million. And so it doesn't take an investor too many deals to forget about all those other investments when you have a big win. And that's the same for VCs and private equity. It's a numbers game. So
thanks. Yeah, thanks, Steve. Talking about co-founder, Co-Founders Lab really helped me. The thing is, I message about 100, potential co-founders that I look for on the Co-Founders Lab, and at the end, about 5 approached me, replied back, and I got a Zoom of 3 out of 5, and I managed to lock in 1. So it was hard. But yeah, you're right. Solopreneurs is not easy.
I got to tell you, man, and this is for everybody. It takes a long time to find a co-founder. Co-Founders Lab, before we acquired Co-Founders Lab, they bought a company called Founder Dating. And Founder Dating, is a great premise. It's like, you date a founder to see what it's like. Finding a co-founder is like a marriage. And you have to be really careful, not to get engaged and pregnant and married before you fully understand, who you're climbing into bed with. So you got to be careful. The other thing that I will emphasize to everybody, And the reason why we started the advisor network is, again, as an advisor, as an investor, if I see that you have advisors on your platform that are smart guys like Pedro and Erik and other people, and you've got 3 advisors, there's a twofold benefit to that. Number one, you can form an advisory group, and we're just starting to do this on the Co-Founders Lab Advisor Network, where you can literally go to our concierge that we have helping with the advisor platform and say, I want to find 3 advisors that I want to meet with quarterly, right? And so we're starting to put together advisory boards. The benefit of that is, even if you don't have a lot of money, for you to get 3 or 4 advisors, to your company makes you look rich, gives you depth, gives you expertise with amazing people who, by the way, in most cases will pay for themselves in 1 or 2 sessions in terms of mistakes you made and benefits to your company. It is so smart to get people to work with, in an advisory capacity. As an investor, I love to see advisors on there because I know that you're not living in a myopic world. Investors are people who will give you good advice. And by the way, investors may know other potential co-founders. So as you expand your community, as you start to go out and look for investors, it costs you very little to hire 3 or 4 investors once a quarter. And trust me when I tell you this, it'll be the best investment you ever made to get a group of people on, meet with them individually once a month, meet with them as a group once a quarter, and you'll be amazed at how much you'll learn and fewer mistakes made, newer contacts, new ideas. It's a great way to go.
Thanks, Steve.
Yeah.
Thanks.
Just wanted to comment on something that was an interesting idea. So I think the best way for me to know that you have found the right co-founder is actually, at the end of the day, so that's the metric that I use, is at the end of the day, you want to give him a call and talk for 1 hour. That's the best way. Like, if you feel like this, you don't need to be forced to do it. You're just like, hey, I just want to catch up today, see how things went, like what his thoughts or her thoughts on this process. And you just want to maybe talk about the business future, or not just like a formal thing, but you just want to catch up. If you have this, that means that you are really aligned with the co-founder, and you should, think about this long-term. I was very lucky to find my co-founders in college. So we actually, to go into different parties and everything. So that was a great way to find our co-founders, but we have been, together now for 8 years. And usually we feel the same thing. We talk every day in the beginning, and that's a great way to know that you have found the right co-founder for you. Yeah.
Great. Thanks, Pedro. Anything else on investment thesis, Erik, and strategy and amount of investments and frequency? Any thoughts on that from your side?
I would just say, do your research, right? And make sure that you're targeting the right investors. It will take time, right? You've got to have the right investment strategy and developing. I think raising money is like sales. It is sales, right? You've got to develop your investors just as you're developing your customers. So you've got to have the right strategy, target the right investors. It's going to take work to do that and really understand what those investors are interested in, right? And most investors will publicly or privately, also if you reach out to them, tell you what they're interested in terms of check size, in terms of segments, in terms of industry, life cycle, et cetera. I see a lot of startups going after the wrong investor segments. And it's just a waste of time, right? And then just from an angel perspective, since the question was in terms of check size and so on, there's a wide variety of angels out there. Some place a lot of small bets, some place big check sizes. The angel groups out there, all variety of sizes. I'm part of 2 angel groups here in Boston. One is called Walnut Ventures. We're about 40 members, so more towards the smaller size. And then also Launchpad Venture Group, which is about 150 members. And that tends to be where the angel groups tend to meet out on about 150 members, after which it becomes unmanageable. And the way that we operate, the amounts of checks that we write on a yearly basis and how we interact with startups differs as well. Walnut tends to be very organic, very members driven, versus Launchpad is very process oriented. And if you look at, let's say, the overall money that we invest at Launchpad on a year basis, looking at about $10 to $12 million overall. I think we've invested for about 16 years now, and typically the return for us, at least from investing perspective, is at about the 10 to 12 year mark. And typically the companies that have not been the big TechCrunch type of exits, right? It's been the ones that mid-tier, $30, $40 million companies, under the radar, healthy businesses that eventually got acquired.
Great. Thanks, Erik. Going on to the next question. So, am I pronouncing it correctly? Is it CYPRIAN? Is that correct?
Yes, correct.
Great. So if you just announce your name and 30-second elevator pitch on your startup, and then you can lead into your question. I know you private messaged me. Yeah, go ahead.
Yeah, sure. Thank you. My name is CYPRIAN Moses. I'm from Tanzania, East Africa. I'm the CEO and founder of Uduma Plus. We have invented AngerNet as a new satellite communication network. Our system is different. Currently, the satellite networks cannot share data between different institutions. So with AngerNet, multiple institutions with different space missions can share data through our AngerNet systems. So we have developed a prototype for 2 years now, and it has been very, very hard to raise capital to scale and develop an MVP that can be used in the industry. So we have been stuck now. In Africa, it's very hard to be in an industry such as satellites, communication industry, and the space sector is very vibrant in outside Africa. So we have been getting a lot of challenges in raising capital, and then that's why I wanted to ask, what is your advice for emerging entrepreneurs, especially in Africa continent, that we're trying to raise capital, especially in the space sector, and what do you have to advise us? We have a product, we have a prototype, but it takes like 2.5 million to launch our AngerNet system in space and start getting traction and customers, but we can't raise it here, and it has been very, very, very hard to get such kind of capital. So would you give us advice maybe which are the steps or experiences with some founders who have helped from Africa, especially in Tanzania or in East Africa, wherever, that would help us to really get this kind of capital and launch our AngerNet system? Thank you.
Thanks. So curious, either Pedro or Erik or Steve, anybody have any experience with outside investments, specifically in Africa? First, just to do a quick check-in on raising capital. Any thoughts on that? And if not, we'll just talk about.
I've never done anything in Africa. I tend to stay, within the United States. But I'll tell you what you may want to take a look at. There may be a governmental application for your service. And look, it's hard to raise $2.5 million anywhere for a technology that, still has not launched. And it sounds like you had to do a pivot and now you need money to relaunch, correct?
No, it was a research based. It was a research project that me and my colleagues, it was a PhD research thesis that we now try to commercialize it. So it just functions, but not yet in space. So you have to launch it and test it right away from space, like just not having it. We were yet to launch it in space. So we wanted to just launch the infrastructure in space, and yeah, so we were yet to launch it in space.
I wouldn't really look for a traditional investor here, because you're dealing with launching something into space. You may want to try to find a strategic partner. This may be, take a look at the people who are paying to go up through SpaceX and see if you can find any names that might be interesting potential strategic partners that would like to piggyback, what you're doing with what they're doing, or companies that have synergies. Look, you're a PhD, you're credentialed. I don't know if the university has any capital that they They put to work on projects for students who have graduated from the university. But, you know, they certainly have a network of people. And because you're a PhD, you know, you may want to try to tap into the network at the university to see what it is. But, you know, look for some strategics. I don't know the landscape at all in Africa with regard to, you know, private equity, venture capital, or family offices. So I can't speak intelligently about that. But look, it's, you know, Elon Musk is trying right now to set up internet access, launch, is it 12,000 satellites or 20,000?
Yeah, Starlink, yeah.
Yeah, and so look, there are people out there, and there are about 5+ companies out trying to do the same thing. So you may want to reach out and try to find somebody who's in that space that you could be synergistic with. You know, and the fact that you're a PhD helps because it gives you instant credibility. You know, then it's a matter of whether or not your business thesis works, and whether they believe in you know, your business proposal.
Yeah,
Okay, sure. Yeah, I appreciate it.
Yeah,
one thing that I want to.
Pedro, or Erik or Pedro?
Ahead, Pedro.
Yeah, I think like Elon Musk actually came from South Africa, so he's a good example of you know, great African entrepreneur and building global businesses. I myself, for example, I was born in a small village in the countryside in the middle of South America, and I was able to, you know, you can grow the business in multiple steps. That's usually my thought. You know, how can you split the business in multiple steps so you can go where you want? Sometimes, as Steve said, you can reach out to universities like MIT, for example. They have a challenge right now that's open for innovators in this equity space. So you may be able to reach out to them, apply your idea, apply your business, and then be able to get some funding. And then if you have the chance, even if it takes 5 years, 10 years to go, let's say, to the US, then when you do that, when you're here, you'll be able to raise funds, you're able to develop technology, and then you can also go back and invest again in Africa, you know, but you have this option to merge both businesses. We have been doing this for 10 years. And one thing that I can tell you is that we have customers now in 40 countries. And the process of doing that was not like we got 40 countries in one single day. It was like one country, then we went to another country. And then doing this process over the years, you'll be able to grow a global business. So my best advice is just try to get the first path. Like, how can you do the best MVP with the lowest amount of capital? And how can you partner, just as Steve said, with these companies? Try to reach out to SpaceX, other companies, and also apply for these, you know, grants in the US where you can be able to get your business going. And it may not take like 6 months. Actually, if you're based here in America, something's going to take 6 months, maybe take, you know, 3 years to 5 years when you're outside of America. But if you have a long-term perspective, like, you're still going to do it. Like, it's more about like your resilience and where you want to go than, you know, just the opportunity that we have. Because if you're really focused, you can get there.
Thank you.
Yeah,
Thank you so much.
Just one point. I agree with all the comments around alternative sources of funding. I think that they're out there, right? You have to find them. There is it's more a venture fund, I think, over here called Space Angels. And I think it's more a venture fund model versus a straight angel investment group, but they do invest specifically in space-based companies, including SpaceX. You might want to do some research in there,
yeah,
and see who they've invested in.
Yeah, thank you so much.
Another thing, if I might add, Joshua, you know, in terms of raising funds for high tech or deep tech, it's never easy. I have worked with a lot of university startups that coach them and mentor them, and most of these deep tech startups, if you want grants like the other guys were saying, and other non-traditional funding, you have to angle your solution towards more of humanistic kind of way, and there's a lot of grants out there, not only necessarily government grants, but even non-government grants like WHO, and, you know, there's a lot. I can give you a link later that I know one startup managed to raise about, you know, $300 US. I know that's not much compared to what you're trying to get at, but if you manage to build up and also, not to say the whole thing pivot, I know probably now you're very commercial oriented in terms of solving your solution, but when you want to go for grants and other these non-commercial grants and funding, you have to find ways how to support the low-end poverty kind of income group kind of thing. I know it's satellite based, but there is a way to get these big grants from the government. Anyway, that's my 2 cents.
Thanks. And again, if you guys have comments, there was another good comment in the notes from Brian. So feel free to write other comments if you guys have suggestions when anybody's on here. So I'm going to move we're running a little bit low on time. Michael had a question from Hatch Track. Michael said, we bootstrapped everything. Our focus is on app plus retail to assist backyard poultry keepers with egg incubation. We have an additional product we're selling to raise money. I'm interested in your thoughts on how investors will view side products generating small amounts of revenue while pitching. So curious, Erik, what are your thoughts on, as an investor's perspective, when a company has side revenue projects? How do you view that?
My perspective is I like focus for companies, and I prefer not to. My concern will be, given your focus on the business, right? Can you keep that focus on really growing your core business, right? As opposed to focusing on, let's say, your side revenue, adding additional side revenue channels, unless they really feed back into your business overall. And I think you'll find that too, that the majority of investors, at least that I interact with and work with, they really like companies that focus on something very specific as opposed to having a multi-business type of model.
Would it be something you would leave out of the pitch?
Unless it really, and again, I don't know that much about your business, right? But unless it really feeds into growing your overall business in a future vision, right? You may say, okay, we're growing, let's argue growing a platform, right? You're building a platform, and you've got the side revenue stream that could potentially feed back into the platform longer term and really feed your longer term vision. That might be an interesting play, right? And I'm not saying that having multiple revenue streams is bad, right? The question is, what are you focused on right now with the money that I'm giving you? And can you accomplish the milestones that you're promising, right? To really come back to get that next round of investment. So that's what I'm looking for. Sometimes you hear investors saying, "Hey, in the pitch, right? Tell me what you're gonna do. Don't tell me about the long-term vision." I disagree with that as well, right? Let's say you do have a platform play. A lot of times those turn into data plays, right? But longer term, once you get that network effect, I'd like to hear about that, right? But again, I just wanted to understand whether that side revenue that you're having right now could be a potential distraction to your business or not, and everything that you're focused on. If not, then that might be an interesting play.
Okay, yeah, it's certainly something that could add visibility. It's in the same market, backyard poultry market. It's really splints for young poultry feet. So it really raises awareness of the brand, raises awareness of what we're doing, but only kind of marginally connected to the product that we want to focus on. But it also is not really a distraction. We have them, we distribute them. We don't really need to put any more time and effort. It was really something that we're going to use to continue bringing in money while we were fundraising so that we could keep going.
Okay. We actually had 7 businesses at a given time in the beginning. So that can be a great way for you to test ideas, you should not do that for, on the long run, but if you can quickly test them and see how they benefit your business, I think that can be a really great thing. Even for you to understand the market a little bit better, this can be a really great ways to get traction.
Okay, great. Yeah, we've launched a couple of different things to varying degrees of success and failure, but really are focused on the one for as kind of the startup. Sorry for the children screaming. Welcome to the world of COVID-19. Thank you.
Yeah, thanks, Michael. Thanks, Eric. Gina, this is probably the last question. Gina, I wanted to get to your question. Can you hear us okay? Great.
Yes, I can hear you.
So your question's around, is it good to have a tech company take part in equity in the company when you're building out the MVP? So you're saying, hey, I have a company that wants to help me build my MVP. Should I give them equity or should I wait for a tech co-founder? Is that what you're asking?
Yep. Very good.
Great. Either Pedro or Erik, first thoughts on that.
Pedro, you want to go ahead? Or?
Erik, you have questions or thoughts?
Yeah, I'll go ahead. There are different models out there, right? In terms of, there might be a professional services company or consultancy that will take equity, right, to build out your MVP. There are also other models such as venture studios, right, that take a share, and sometimes a fair amount, right, may take 10, 20, up to 30% of equity, which is a high price to pay, right? I would be careful about really looking at the model and what's the motivation for them, right? Because ultimately, if it's a consultancy or an IT firm, they still need to focus on their margins and the services revenue. So what happens at a point when you've got to build out additional features and they can't afford anymore to take additional equity, right? Do you then have to start paying the bills? So I just be careful about that. I have seen it work in the past. And sometimes it's a combination of cash and equity as well. But just make sure that you are aligned in terms of your motivations, right, on both ends, and understand, how you're actually, and have the right terms and conditions with the company too.
Right, thank you.
I think that's great advice from Erik. The only other thing I'll add is, look, we've seen through people on this platform that have been ripped off terribly by giving up equity and paying cash. For everybody out there, do your homework, do your due diligence on any tech company, on any company that you're thinking of giving up equity for, and you stage your equity in based on them accomplishing certain benchmarks. So, you never want to give too much equity in advance. You want to, if you want to give them a little, it's okay. If you feel very confident, if they put work in, they put a game plan, a deck, a blueprint, something where you see that they have spent time and energy and effort on this thing, then it's okay maybe to give them a little going in. But we've seen way too many people get ripped off. One of the Startup Accelerator, people on the platform lost $250,000 to a tech firm that made him pay the majority of it in advance, never delivered. So you just got to be really careful. There's some great companies who can really help you, and I'm not trying to be paranoid here, but I'm saying go in with your eyes open. All right, do your due diligence. It's super important. So that would be my advice.
One other additional piece is there's also certain technology where you can own where it's hosted. Like there's the way that they code, and you own that piece. So you're giving them access to develop code in which you actually own. That way it's a way of having control. Because another thing that I've seen done is they build it and they say they own it or they keep it. So, and then what you can also do is we have a lot of tech co-founders or advisors in our network, which have been around for a long time and can just help look over your shoulder to say, look at what the code, because there's different types of code. Some are outdated, some are newer. So if it's not your language, it's helpful to have somebody else to just look at it and say, does it make sense what they're talking about? Can it be developed? Is it new or is it outdated? Because when we've looked at different pieces of code, sometimes it was outdated and they used the wrong code based on who they wanted to work with. And it creates a little bit more problems.
Right. And then it has to be built all over again, basically.
Yeah, it's a short-term solution versus a long-term solution.
I'm going through that with one company right now that had they outsourced their executive summary, their deck, and the most important thing were their models and their financials. And now the company is holding them hostage. They're saying, look, we're here and we will make the changes, for X number of dollars, but they have kept everything proprietary that they have used on every level outside of technology. So you want to be really careful, to Josh's point, and make sure that you own and have rights on the IP, trademarks, whatever it is, technology.
Right. Whatever they're building, I should own it. Like
you need to own it. Correct.
Yeah, there's a cool called GitHub, just for technology a lot of times, and that's where people code in, and you own the GitHub location, and then they sign in and build on it. So different people are building in, but you still own where it's built on. So there's tools like that are helpful.
And just make sure that you have a person independent person that you have hired through other means that can review this code and provide your assessment, someone that's completely disconnected so they can do something independent and say, hey, can you take a look on this? Is that the complete thing? Because they're going to do an assessment and they cannot know the person that developed this. So that can be a great way of doing this. Also, long-term thinking, just think about the co-founder, think about the technical co-founder, because at one moment, probably when you're generating hundreds of millions of dollars, you're probably going to need your tech team and in-house being part of your team, and you need to share this with your founding team too.
Right. Well, I'm thinking myself, I can use them down the years to keep building this because it's only the first part, the MVP going out, and I'm thinking if I build this relationship with them, which I've been doing over a couple months, but still it's scary. I have to put up money and I also have to put up equity for them to even build this out. And I'm like, how's that?
So Gina, to that point, we've had a couple people, Steve, actually, when he was doing, we were initially working with some of the founders, and that was exactly, somebody pitched a deal to a founder. When we actually ran the numbers, they were going to pay just as much as they would pay somebody to do it and give up equity, than just have somebody to pay it. So whenever you get a deal, that's why sometimes it's helpful to have that. Kasha just posted the link to our advisor network where we vetted advisors that are doing
I'm on that. I just started that last week. Right. So I'm going to start putting things out there because I don't want to sign anything or do anything until I really, really am 100% sure, because I got ripped off already and I don't want to do it again. So
great. Yeah. Thanks so much.
I appreciate it.
Yeah. And I just wanted to thank both Erik, thanks for joining us today, and Pedro, thanks so much for joining us. We just posted the link. They are both in our advisors network. So you guys can do one-on-one sessions and find and book a session with them and get feedback on your startup. They're both amazing advisors, and they've been on here a number of times and are really helpful and useful. We also have the link for the Co-Founders Lab Startup Accelerator. So if you want to get first in line for getting your questions answered, or you want to get in line for a pitch practice, or just the content. I saw, Charles, you were doing some coaching, was saying, hey, have you solved a problem, and using some of the, the frameworks and roadmap to a startup and building that out. If you have questions on the modules, we've built that out from start to finish. That really fleshes all that out for questions. So we also have the link in there. And anything else you want to add, Steve?
Yeah, we also, again, those of you in our Startup Accelerator know that we have an aligned relationship with a group called 1,000 Angels. And when our companies are ready in Startup Accelerator, we present them to Erica Deegan. You may have seen some of her webinars. You may have seen some of her videos on the platform. But Erica's got a pretty interesting model. It's almost a qualified investor model, little different than angel, but some of the same concepts. But she has investors pay her to find deals. And a lot of the companies that she presents to her investor group get funded. So, they're an affiliated company of ours. We actually own a small percentage of 1,000 Angels, and she has had tremendous success, in helping to get companies funded. The last thing, you will be receiving a direct email. We found a company that we love. You can look them up if you have a minute. It's called Founder Suite. They have a technology that is essentially, it's a database of angel VCs, private equity, family offices, investors by sector, and it basically creates your own funnel to funding. And we have an aligned relationship. We found this company, as we oftentimes do. We look for cool things for our platform. So keep your eyes peeled for an invite from a company called Founder Suite that will come through us. There's going to be a big discount. You could take a look at it online free. It's awesome. I love this company. I would like I'd like to buy this company. So it is perfect for Co-Founders Lab. They have created a really unique technology that starts down a funnel to funding. So keep your eyes peeled for that. And if you want to, you can just go to foundersuite.com and take a look at it. And by the way, we have no vested interest in this company. I was blown away by how cool the tech was. And we'll have a special offer for our community. So
yeah, hey Steve, I recommend it. I use it with the companies I work with as well. So
yeah, it's cool. Very cool.
Yeah, it's really cool.
And lastly, we'll end with group photo. Always fun to take group photos. So everybody will turn their camera on, give us a nice little smile, maybe give us a wave or a thumbs up or hang loose, or whatever sounds fun. It's always fun to just see all your smiling faces from all over the world and do a group shot to show that we are, as entrepreneurs, working together to solve problems, and also turn the cameras on. We got most of the cameras on. Good to see your faces. Okay, we're going to go ahead and take a snapshot. Go ahead and smile, wave, do whatever you want. Great. And then it just as a reminder, it's you are the future. So as entrepreneurs, you are creating the future. Keep staying after it. Keep staying focused. Even when you run into a roadblock, find a way around, break the door down, keep staying after it, because you're really the innovation and we're the future. So we're grateful that you're here. Any way that we can help you get to the next level, that's our goal with Co-Founders Lab, whether it's finding a co-founder, helping you find other team members, giving you excellent advice from advisors, or helping you get funding for your startup. So thanks everybody for joining us today. Thanks both Erik, Pedro, and Steve.
Thanks, Josh.
Thanks, guys.
Bye, everybody.